or just rest with your family. So we thank you for showing up nonetheless. And my name is Juliet Ola. And for those of us that don't know me, and I have the privilege of facilitating today's session. And I'm excited actually to be a facilitator on this particular interesting topic because it's something I really love to talk about myself. So, and it's so timely for most of us. So we are welcoming you all to listen up, grab your pen, grab your notepad for this conversation on understanding, investing, and the stock market. And before I bring a guest speaker on board, I would also like to let everyone understand that for us to grasp everything today, we don't want any form of distraction. So please, if your microphone is on or when you come in, for those that will still come in, please make sure it is muted almost immediately so we don't distract others. And if you have questions along the line, please feel free to drop it in the chat. And we would still have the Q&A session though after the 30 minutes training. So let's get the question coming. Let's keep the chats, flowing as well. We just don't want to listen and like move away from here. So we are honored today to have with us one of us, our very own Pastor Lanre Olabinjo. So good to have you, Pastor Lanre. So briefly, we cannot give everything about Pastor Lanre, but the brief summary for him that we need us to be aware of so that we understand how much he has to offer us. Is someone with over 2 decades of experience in engineering, business, and management consulting. He has MBA from the Rice University, and his deep understanding of financial systems have empowered many people to make informed decisions. So beyond his expertise, he has a passion for helping individuals maximize their God-given potentials through wealth creation and stewardship. The word for me is wealth creation and stewardship. And we are ready to dive deep into what Pastor Lanre has to offer us. So without further ado, everyone, let's join me. Go to the chat. Let's prepare ourselves in welcoming Pastor Lanre Olabinjo. You're welcome, Pastor Lanre. The floor is yours.
Thank you, Juliet. Appreciate the introduction. And thanks to the leadership of NIWT, I appreciate what everyone is doing. There are a lot of good work going on by the group, so I really, truly appreciate that. I'm going to dive into it. This is a very deep topic, and 30 minutes is really, not the time to kind of get into depth on this subject. If anything, it's really to kind of stimulate our thinking along some very, very critical subject in this respect. So I'm going to just go ahead and get into it. Please, can you confirm if you can see my screen, Juliet?
Yes, sir.
All right. Can you hear me clearly as well?
Absolutely.
Excellent. All right. And let me see if I can get the pointer to work. If not, that's fine as well. All right. All right. So there are two sides to the teaching, right? Or to the session. One is on investing, just generally understanding investing. And then the other side is the stock market. I really would like to kind of explain a little bit about each one as the Lord will help us. I'm a pastor, so please pardon me. I would probably get into that frame of mind and say things that has to do with the Lord and all of that in the course of this session. So I always kind of use the illustration of investing as being like sowing a seed, being a farmer. Honestly speaking, that is really what investing is about. And when you look at the scriptures, there is a lot of things that helps us to understand what investing is. There's a lot of analogies between farming and investing. Honestly, investing really is nothing but just taking a seed out of that which you have and putting it into the ground. That's really all investing is. When you hear a lot of people talk about it, it seems as if it's something very abstract, something really difficult that only some special people know how to do or should know how to do. That is a lie of the devil. It's pretty simple. You just need to know what you need to do and really do it well. The key to investing is really one very, very simple thing. It's time. Time. A mindset that is not just looking for a quick gain, but wants to really make this, make something out of their finances in the long run. And I will say a few things about that as we go on. There are two scriptures on the screen that I would like to just read quickly. Psalm 126 says in verse 6, that he that goes forth and weeps and is weeping, bearing precious seeds, shall without a doubt come back. Note that word, doubtless. Without a doubt, he will come back again rejoicing, bringing his sheaves with him. That's really what investing. When you are investing, it might be painful to you because it might be funds that you want to use for something else, or maybe even to go buy, yourself some nice car or some nice, wig or something for women. But you take that thing and you put it into an investment with the intention that even though I'm denying myself in the short run, I'm looking for something in the long run. That's the goal of investing. The scripture says in Ecclesiastes 11 that in the morning sow your seed. Even when you've sown in the morning, don't say, well, I've already sown, I'm going to give up, it's enough, I've done enough. It says in the evening, don't withhold your hand. You don't know which one will prosper. You need to invest on a continual basis is really the key point. And the key to success when you're farming, I think this is very intuitive, but for some reason, many people still don't get it. You'll never see a farmer that puts a seed in the soil and goes there the next day, tilling that soil to see if the seed is grown already. Because it takes time for a seed to truly germinate, for the earth to work on the seed, the seed actually dies for a season completely, and then it comes back to life. Exactly the same process happens when you invest. It seems as if that thing that you have put aside, that portion of your harvest, now we're talking for financial harvest now, whatever God has given you financially, a portion of it, and putting it into the ground, it seems as if it's dead. But really and truly, as in this case of a seed, it's only placed in the ground to return to you in the future. And the good thing about seeds, and I was teaching somewhere recently and explained this, a seed does not come back in the same proportion as you put it into the ground. It comes back in multiple proportions. That is the power of investing. You don't get exactly the same thing you put into the ground, but you need time. That's really the critical thing. That's another scripture in 2 Corinthians chapter 9 from verse 6 says, he which sows sparingly, the individual, the man, the woman that sows sparingly, you can be sure you will also reap sparingly. But if you sow bountifully, you will reap bountifully. Again, I'm using scriptural things. That's what I gravitate towards. But the key point is investing is like being a farmer, putting a seed in the ground and allowing that seed to, for the soil, the power that God has already placed in the soil to work on that seed. No farmer goes there the next day and is trying to, get the fruit of what he just planted yesterday. Why invest? Let me not get ahead of myself, actually. I don't know how many of us knows this guy on the screen, Charlie Munger. You probably have heard the name of Warren Buffett. Charlie Munger is Warren Buffett's partner. There were three of them. Again, I don't have time to go into the details of that. But Charlie Munger had this quote that the first rule of compounding is never interrupt it unnecessarily. I was talking about the power of time earlier on. When you think about investing, always think about time. When you invest, you need to keep in mind that why you are investing is that you want to allow the power of compounding. If there's one word I want you to live with this evening, is that keyword, compounding. One of these, what's his name? One of these this mathematician, whatever his name is, he said, compound interest is the eighth wonder of the world. And really, that thing is so powerful. When you think about it, what I have on my screen right now Now, when I explain this to people, for many people that sees this the first time, there's like an eye opener for many people. Well, what I'm showing on the screen is like the power of $60. The power of $60 invested monthly over time. If you look at this screen, again, time will not let me spend, kind of do justice to this, but I will explain what it is. If you look at the screen and there is a portion where I am pointing to, if you can see my pointer. If you can't see my pointer, that's fine. The section under the column that has 10%. The average return in the stock market, again, because we're talking about stock, there are different investments, but the focus tonight is around stocks. The column under the 10%, those are the value of the returns over time and the years of contributing that $60. $60 a month times 12 months is $720 a year. So putting $720 a year aside and investing it essentially once a year over time. If you look at what happens initially, year 5 that I colored in like a maroon color there, after 5 years, 720 multiplied by 5 is almost 5,000. 7 times 5 is what? 35, 3,600, 1,500, something like that. If you look at the result, it's just $4,300, $4,400. So it seems as if I've been putting all this money aside, it's not growing. And this is why when many people give up and like, this thing is not working, I'm walking away from it. Because time is the key to investing. It's actually an exponential function for those that remember the mathematics in that respect. It's an exponential function. If you look at an exponential function, in the earlier time on any of charts that it's on, it does not really seem to be growing. But when the power of time kicks in, it grows. It seems as if it takes a life of its own, and it begins to grow multiple folds compared with what you're putting in. Look at what happens. So the first 5 years, just 4,000 plus. The next 5 years, it becomes 11,000. After the next 5 years, which is the next column, it now doubles. So the first 10 years, it's almost like a linear, growth. What you will have contributed in the first 10 years is somewhere in the range of 7,000 something. 7,200, actually 720 times 10, 7,200. And all that you get on top of it is what? It's like 3,200. Many people give up at that point. But look at what happens in the next 5 years. The same contribution now, you only contributed 3,500, but the money has now doubled. So your total contribution in 15 years is now just over 10,000. But now you now have 22,000. That is the power of compounding, but compounding needs time. I don't have time to explain this as much as I would like to. But one last thing on this is that $60 can become multi-million dollars. $60. Money that people will take to McDonald's and not even think about it. That cup of coffee, that cup of, what do you call it now? Starbucks can be what is costing you millions of dollars if you're not careful. $60 here is 2.1 million. How can $60 become 2.1 million? It's the power of time. Let me show you something. My screen here, let me just move this around a little bit. How can $60 become $200 million? $200 million over time. It's almost impossible, but it's so true. It's so real. The formula that I have running here is the same principle. The problem with many people is that compound interest works, but it works against them because they allow debt to be what they lean on. The same principle that works in investing works when you take a loan. The only problem is now working contrary to you. It's working against you. And that is why many people struggle. You can imagine if it's the same $60 that you are collecting from bank or something. If you're not careful, it will become multi-millions over time. And people then fall into the old and I don't know what is happening. It's because compound interest is working against you. Anyway, please, a couple of keywords tonight. Investing is like sowing a seed. Number 2 thing is that you need time. The criticality when it comes to the critical element when it comes to investing is time. Time is what makes investing work and work well. The last presenters on this forum, I was listening in, and the individual, the man was talking about the rule of 72, and many people don't realize how much, some people go to a store and they say they're doing sale. So they give you a credit card, and if you don't use our credit card, we will, you will lose something. I tell people there's always sale, that if you take a credit card and they put an interest rate, some people don't even look at what is the interest rate on that card. Let's say the interest rate is 25%, just to use a number that's on this screen.
Sorry to
That's
interrupt
70,
you, sir.
that's 25%. And the man was explaining, that's what is called the rule of 72. Essentially, it's just, the result of
Pastor
compounding.
Olabinjo, I'm sorry, sir.
Yes,
I'm sorry
yes.
to interrupt you. Please,
Go ahead.
you can go as much as an hour. Please, this topic is not something we want to rush. So we need you to.
Okay, I will,
take
but
time.
also let's give people time to ask questions. Yeah,
All right,
thank
sir.
you. There's the rule of 72. So someone goes to a store and they tell you, you can take a credit and all these things that they say. Okay, many people don't even read, the terms of the credit, and they take it. Every 3 years, that money will double if you don't pay it back. 72 divided by 25 is the time the money will double. And I won't re-explain it. It was explaining it during that teaching 2 weeks ago. The money will double. The debt will double every 3 years. So many people make minimum payment on their credit card. And the sad thing is that the money begins to grow. And then it grows to a point, I was explaining earlier on, that the power of exponential function kicks in. So it now starts working against you at a rate that you can't even keep up with anymore. Now the power of investing is working against you because you're working. That's why the Bible says that the borrower is a servant to the lender. You're working for the bank. Now, I tell people, the bank does not like you. Why then do they beg you to come and collect their money? Why will anybody beg you to come and collect their money? Because they know there are things that you don't know that they want to take advantage of. I pray that we will have kind of think about some of these things. I wish I had time to really get into details on some of these things. But again, it's to whet our appetite and cause us to really think about some things. I put a note at the bottom of this that mastering money is about mastering yourself and your emotions. And that is so true. Why do you need that thing? Do you really need it? People say, I need it. Is it a need, or is it just something you want because somebody else has it? There's a saying in my language that if you are not as big as a hippopotamus, you don't breathe like one. People live beyond their means and they are struggling to make ends meet. The man that was the first billionaire in the US, actually in the world, his name is Rockefeller, for those that know that name. He said something. He said, if you can't save at least 10% of whatever you make, and it doesn't matter whatever you make, that the seed of greatness and financial freedom is not in you. If you can't set aside 10% of whatever you make, it doesn't matter what you make, whether you're making $50 a month or $500 a month, you need to put yourself in a place where you can save 10% a month. That if you don't, the seed of financial greatness or the seed of financial freedom is not in you. Let's think about that. I won't be able to get into various investment vehicles, but I will talk about stocks quite a bit tonight as the second element of this teaching, or the second side of this teaching. But I want us to know that investing is so, there are various options. There are different things you need to do or you need to know about. There's something that I'll be sharing with us tonight, some statistics, as I get into stocks a little bit more. There are different elements anyway of investment, stocks, funds. Many people participate in companies 401k, 403b, and things like that. I tell people, someone said, I can't afford to. I tell people, no, you can't afford not to. You can't afford to work in a company that offers 401k, 403b, which is the government, non-profit, and then 457 are like the government type deal, and not participate. You can't afford not to. If you don't, then you are mortgaging your future, financially speaking, as it were. And then you should have, individual retirement account. The guy the last time talked quite a bit about insurance. Insurance is so critical. It's an hedge that you use to, in your investment portfolio. Of course, you should be saving for your children's future. There are bonds, there are investment in real estate directly, or you can invest through trust, REIT they call it. Insurance, I talked about that. He spent a lot of time on that, so I'm not going to really talk about that tonight. Annuities, derivatives, I'll talk. I wish I had time actually. So derivatives, and then there are other things you can invest in, golds and stuff like that. I always tell people, even though the focus tonight is on stocks, your goal is asset allocation and diversification. There are two different things. Asset allocation really is about putting your funds into various types of asset classes. So there are stocks, but there is also real estate. Those things will behave differently. There are bonds and treasury bills. Those things behave differently at different seasons. So you should have assets across those different classes to diversify so that you're not linked, your performance is not linked to a particular asset class. And then even within a particular asset class, you want to be completely diversified. You don't want to be in a stock that's just in the tech industry, for example, or just in the US. You want to be diversified across various assets within the same asset class. So the key along all of this, to summarize this, is that as you begin to invest, you need to be thinking about how will you allocate your asset such that you're not tied to one party. You don't put all your eggs in one basket, as they say. Many people stay away from the stock market because they say it's risky. And I tell people, what is risky is the fact that we don't really understand what we're doing. And my hope is that we'll think about what we should be doing a little bit as we talk tonight. All right. So now let's dive a little bit into the stock market. And Horton said, the stock market is the greatest opportunity machine ever created. Financial opportunity was referring to. He says the stock market is the greatest opportunity machine ever created. Matthew Crater is his name. And it's so true. But what's a stock? Again, this may be very basic, but I just want to be sure we're on the same page. I think we all know what a stock is, but I'll still define it anyway. Honestly, it's nothing but a piece of a pie. A stock is a share ownership in a company. It's a ownership of a part of a company. If I go to the market, the stock market now specifically speaking, and I buy one share of Walmart, I become a part owner in Walmart. Even though all I own is one share, I become a part owner in Walmart. And that is why it's called a shareholder. I own a share of Walmart. Excuse me, please. So think about a share as a piece of the big pie, whatever the pie size of the pie is. And honestly, if you actually have enough money, you could go to the market and buy the whole shares that is in the market. They call it shares outstanding. It's referred to as shares outstanding. The whole number of shares, let's say the company has 1 billion shares. If you have enough money and you can buy it, you can actually own that company. And that's why, what's the name of this guy? Elon Musk. He bought Twitter because he bought all their shares essentially. As it were, at that point, they had gone private, but they can do the valuation and you can buy it. And then, that value of the company is called market capitalization, which is simply the price of one stock of that company multiplied by its total number of stock in the market, or referred to as stock outstanding. That's the max. So if I have enough money, you can start by buying one, but you can actually buy the whole company at the end of the day if you have enough money. So that's a stock. It's just a piece of the company. Now, this is one thing. If you don't leave with anything on this second section of this training or presentation tonight, I want you to please leave with this. This is painful to me. In fact, when Bro Dikinayo asked me about this, I was excited because I like the opportunity to talk about this. I really do. I see a lot of misinformation within our people. When I say our people, I mean particularly Africans and African Americans. There's a lot of misinformation or lack of information, generally speaking. And even where the information is present, people don't truly understand it for some reason or the other. Well, what it has resulted in is, a serious racial divide. When you look at who are those taking advantage of stocks, it's really the white families. it's so sad. I was looking at some of the statistics. That guy said earlier on that the stock market is the greatest financial opportunity machine ever created. And everyone has access to the stock market, is the sad thing, not just the rich. Yet, there is so much disparity. Look at these statistics on the right section of my screen. This is a percentage of stock, of each race's stock. I'm sorry, wealth. The stock as a percentage of their wealth. So let's say the family has stocks and real estate and some other stuff, maybe copyright, whatever it is. Look at the white families and look at the black family. This is really sad as far as I'm concerned. 35% of their wealth is held in stocks, whereas blacks only 8. Stock ownership, this is a recent statistics as of 2022, 65% stock ownership in that year. But look at that last line, median stock and mutual fund, which kind of, there are index funds, there are mutual funds. I don't want to spend time explaining the difference right now because of time. But the point is, when you think about mutual funds, generally speaking, whites have, for a typical white family, they have an equity in those areas of almost 51,000, whereas a black family has 15,000. I was looking at some other statistics, and this is, I know my time is running, but I was given a little bit more time. This is another statistics along the same line. This was actually by a Christian organization, Pew Research Center, and it was looking at what happened over time between 1983 and 2013. If you look at this, so this scale is a logarithmic scale, okay? So 10 and then 1,000, 1,000, 10,000, 100,000, 1 million. So it's logarithmic. The numbers in the lower left on that chart are for blacks. The one at the top, the green, brown, light green, is a average white net worth. Look, I mean, the point is it's over 10 times. The black net worth is over 10 times less than that of a white family. Now, there are many things, other things, and I know that people are going to, if we throw this to an argument or a debate, there will be different things that people will say. So there is more to this, okay? However, it is not unrelated to the fact that we don't invest in the stock market or invest generally. We invest, but we don't truly get this opportunity of the stock market, and we don't stay in the stock market. Those that do, they don't stay for enough time to allow the power of compounding to generate returns for them. I was looking at another statistics recently, and the story is still the same. This is a much more recent statistics that goes all the way till even last year. And it's sad to see this. Again, I've not vetted these numbers, but generally speaking, you can see the scale difference is really the key point that I want to bring out here. You can say it's not perfect, it's wrong, whatever, but the scale is consistently 10 to 15 times more. Why? Because we're not taking advantage of this opportunity that's available to everybody. So it's one thing to also take advantage of it. It's another thing to stay in it for the long run. What I hear a lot, the stock market goes up, and I say it doesn't matter. In fact, I think I have something. Okay, I can show us this. I might have another slide actually that explains, this chart on the top right. Let me see. Okay, I have it here. The key thing here that I want to bring out here is that what most people do is that they go into the stock market and they want to treat it as like they're selling bread. They want to buy $5 today and sell it $2 tomorrow. That's not the way it works. It never works like that. It will never work like that. The key, as I've explained under investing section here, is the power of time. The truth is the market will go up and down. But look at the kind of numbers that I'm quoting on the left frame on this screen. These are numbers, these are statistics. For a 140-year period that Goldman Sachs did a study on, the average return on the stock market is 9.2%. For every 10-year period, along those lines. That's amazing. 9.2% rate of return is huge. You remember, if you look at the chart that I showed you earlier on at the table, the column I was looking at was 10%. So 9% is not too far from 10%. The man that was teaching us, 2 weeks ago was talking about inflation. There is the element of inflation that, needs to be taken into consideration, but again, I won't get into details on that. If you look at the numbers for S&P 500, that has, the annualized average return is around 13%. I mean, those are huge kind of returns. Now, if you look at the numbers in the table in the middle, right, it's not like it's 13% or 9% every year. In fact, there were years that was like minus 4.4. So if somebody had purchased the year before, and maybe at the tail end of the highs of the year before, and sold this next year, will actually have lost 4% if he left the market. But look at what happens the following year. It went back up 31%. And this is what many people see, and they say it's volatile, it's up and down, so I don't want to get into it. No, you can't afford not to be in it. I tell people, in all honesty. But if you think about it rather, the overall trend, as I show in the top right chart here, is that it's on an upward trend. Now, there will be ups and downs. If you look at the red chart, it shows that if you normalize it, there will be times that it goes lower compared with the last year, and then it might go up. So if you're getting, unfortunately, if you're getting in at the tip of the good one and you're leaving at the bottom, you will continually lose money. And that's what many people do, and they say that the stock market is because somebody tells them, the market is exciting. They listen to someone and then they go and invest. And then, the market is bad, and then they get out. You don't get out, you stay in. In fact, and I tell some people that, ladies understand this. They go to the store when there is sale. But when stock is on sale, people leave the store. I'm like, we act exactly opposite. Human psychology causes us to act opposite to what we should be doing. When the market is down, that's when you should be running in to buy. That's when most people are running out. That is when you should be running in to buy. Anyways, the key point is the market generally tends upwards if you give it time. But if you allow, if you go in, without giving it time, you likely will lose in the short run. There was a study done by Charles Schwab, and it took, this is real, 5 people investing $2,000 a year for 20 years. So the total amount contributed starting in 1993 was $40,000. And then they looked at the investor that was getting in at the best timing. So they come in at the bottom of the market and leave at the top, right? And they generally just come in at the bottom rather. Over that period, they made 86. So essentially, it doubled that money plus 7K. The guy that came in at the worst, that is, he always came in at the top of the market, not at the bottom. He came in, he invested when it was most expensive. He still almost doubled his money. So timing doesn't matter. It's not the time, it's not about timing the market. Someone said it's about your time in the market. It's not about timing, it's about your time in it. I think I'll try and finish this in 5 minutes so that I can give people more some time, But look at the man in cash. All he had was 10K more, 11K more. Just barely, maybe he put the money in the money market or something, just barely keeping up with inflation. I tell people all the time that don't wait on the sideline. You miss 100% of the shot you don't take. That's so true as with anything in life. Your goal should be correct asset allocation, as I explained earlier, and diversification. You can't win by sitting on the bench. Fear does not reward anybody, only courage does. If you operate in fear, you've already lost the game before it even starts. You know, I want us to keep in mind that I said earlier on that your key, your goal is long-term, to be long-term focused. Let's keep that in mind. And then let's not invest in people's ideas. People will come to you, this is the good thing or whatever. Don't invest in ideas. Invest in proven products. I wish I had some time to talk about various types of investment, but the point is stock generally return, higher than other investing methods, investment vehicles rather. I listed about 12, 13 earlier on, but you can see in this chart, this is for a period of about 200 years, from 1802 to 2002. Look at the performance of stocks versus bonds versus gold. But the point still remains that you should still balance across those three or various types of asset classes if you want to do this correctly. Let's always think about the fact that your goal is to stay in the market long enough for your overall results. Leave your seed in the soil so that it can yield result. All right. Let me stop there. Actually, let's stop there. Let's stop there so that we can open this up for questions and answers. I will imagine that people have questions, Juliet. So let me just pause there. I could come back to this if I have some time, but let me just pause there and see what questions people may have.
Thank you so much, Pastor Lanre. I wish we actually have the whole day. There's so much to unpack. One, thank you for also considering the time of everyone on this call. Thank you so much. That was a whole lot of nuggets that has quite a lot inside, and I wish we can have you back actually, because this is a very critical topic to break into. So since we are looking at time, I want us to throw in our questions in the chat, or if you want to raise your hands, please do that. We have one person. If you have your questions, please drop it in the chat so we can dive more into what Pastor Lanre has for us today. So, okay, we have Tayo Oresotuk. Please pardon me if I don't say that well. Please unmute and let's have your question, and we have more coming in. Yeah.
All right. Thank you very much. Can you hear me?
Absolutely.
All right. Pastor Larry, thank you so much for that you delivered. Thank you. God bless you. I have a comment and I have a question. Like I said, my name is Tayo Reshotu. I'm the president of Afrik Business Network. I don't want to bore you with what we do, but I'll send more information about that later on. To me, one of the most especially people that came all the way from Nigeria, that's where majority of us are from. The stock market has really been bastardized. That's one of the reasons why people don't have interest when they came to this country to invest. Because the kind of regulations, the kind of discipline, the kind of way things are run here is different from how it's being run back home. But having said that, that's not an excuse. Just to let you know, that's one of the reasons why people scare away when you're showing us the statistics. It's all the same thing in the insurance industry. People have been hurt back home when they put in money and they didn't get nothing in returns, and there's no regulation to really regulate it very well, unlike we have here. So that's one of the mistakes people are really missing out. So having said that, you talk about the long-term investment, that stock is a long-term investment. But there are some other strategy for people that don't have the time, because you can compare over 50-year-old guy with somebody that is coming up 20 years. The time difference it's so enormous. So what can people that are already old, what can they take advantage of, most especially before this stock goes into market? What are the opportunities, other opportunities they can take advantage of? Once again, thank you so much, and thank you, facilitator, and thank you for putting this together. God bless you all.
Yeah, no, thank you. So as far as I'm concerned, Tayo, it's a lame excuse to say because things are bad where we come from. As a result, I don't want to be involved. I know that there are some challenges, but you know what? My An uncle that really opened my eyes to the stock market. He didn't invest in the US. He invested in Nigeria. When he died, he left multiple millions to each child, investing in stocks in Nigeria. So I want us to disabuse our mind. The key thing is that people are short-term focused. That is, for me, as far as I'm concerned, that is the real key. It's not about the fact that, the regulations in Nigeria is not as strong as in the US. There was the scripture that I read. I think I read a scripture earlier on that says, in the morning sow thy seed, and in the evening do not withhold your hand. That's another scripture that says you don't even know which one will yield. I think I read that. Let me see if I read it. I'm not sure I read it, because you don't know which one will bring forth. That is really the truth. So please, I want us to keep this in mind. I wish I had enough time to talk about this. We should not say because things are, even in the US, there are companies, there's a company called Enron, for those that remember the story. Those that left all their stock in Enron, it destroyed their retirement, Again, that's why I said you need to be diversified and asset allocated. So there are processes to go around that, and we should not use the excuse that, because of where we're coming from. It's really not a good excuse. And like I said, the person that taught me this got me thinking about it. He didn't invest in the US. When he died, he left multiple millions to each child. So keep that in mind. All right. And okay, you also had a question around what else. I listed a couple of things. Now there are, a number of issues, but the key point is I hope people will not wait till they are old. Whenever you wake, it's still your money. Whenever you wake up, it's your money, even if your time is short. The thing with people, most people, is that they want a high return. High returns always comes with, high risk. And it's not going to be, if you've started late, you've already lost time. You don't be looking at what else. If you take, I listed at least 12 things or 13 things earlier on. There should be areas there that anyone can look at and invest in. That would be my advice.
Thank you, Pastor Larry, for that response. So we will take the next question. We have Ademola Akoni. Please unmute and ask your question.
Thank you very much, sir, for that detailed teaching. I've been really blessed. Thank you so much, sir. Just a quick question about the stock market. What would be your recommendation about maybe like daily scrappers or probably people that have decided to, because it seems like from your teaching you were trying to, maybe like making long investments pays way better in terms of making profits than probably just quickly going in when it's down and quickly uh, coming out of the stock markets. What would be your take to probably people that are trying to make like the daily scrappers trying to just get in and get out and quickly just make a profit? And also, I know that there's a lot to also talk about in that as well. And what's your take about cryptocurrencies in general, based on your wealth of wisdom as well, sir? Yes, sir. Thank you.
Yeah. Good evening, Brother Demola. Nice to hear you. Day trading is day trading. I want to make sure that I clarify that.
Yes.
Day trading is not investing. Now, I'm not saying people should not day trade, but I can assure you that if you don't know what you're doing, you're going to lose your shirt. You're going to lose a lot of money if you're day trading. Really, that's not what I have focused on tonight. It's not day trading. It's really investing. When I think about investing, and that's why I was explaining the analogy of a farmer earlier on. A farmer requires time for what they put in the soil to produce. True investing requires time. Now, some people make money day trading, and it's, I don't want to say you can't make money there, but there are a number of things you need to learn. It's a very deep, side of the stock market. They are the ones that actually move the market, on a daily basis. That's the price of stock is really trading that moves that on a daily basis. It's not the intrinsic value of the companies that moves the company on a daily basis. So there are people that do make money in there. In fact, that's what some people do for what they do. However, that's not what I was focused on tonight. That was not, and I strongly want to actually advise us against it. Because it's an industry on its own, and you need to know what you're doing if you want to go into it, and actually partner with some other people. There's a process required for that one, All right. So crypto, on the other hand, and I tell people, so the intent behind crypto is, creating a currency that is digital. And all of that, which there's some senses to it. It's useful in some African countries for the world, right? Right now, for example, Kenya is really big in that space. Countries are gravitating towards it. So it's as its place, right? However, it's also one of those investment vehicles that's a little bit crypted, if I want to use that word. It's not as open. The information is not as, you can't really, most companies that you buy, you can study the underlying assets. You can look at, if I tell people to invest, for example, I have, what can I use? Okay, this is an iPhone. I carry an iPhone. I will invest in iPhone because it's a product. I brush my teeth. Everybody brush their teeth every day. So I will invest in a company like Colgate or what's the name of that other company? Procter & Gamble. See, my point is those companies have underlying assets. So when you invest in them, the likelihood that things might go sour, it's lower than if you go in a direction of an asset that does not truly have a solid. Crypto is like a currency trading. It's like trading currencies, which is really not investing. It's really more of a trading, as it were. So that would be my thoughts on crypto. It's going to grow. It's not going anywhere. It's come to stay. But you're not really truly investing in an asset that has, underlying value, but rather in currencies. I hope that helps.
Thank you, sir. Appreciate it. Yes, sir.
Okay, thank you. We'll move on to the next question. We have a question in the chat. It says, Pastor, for many of us who migrated later in life, how do we balance catching up on investments with family responsibilities back home and here in the US? So it further said, this touches on the real struggle between saving for the future and supporting family.
Good. Very, very good question. Okay, so I tell people two things all the time. When you know better, you do better. Now you know. If you didn't know before tonight, now you know that there are some opportunities that we're leaving on the table, especially in our community, number one. Number two is that even though, time and constraints might make it difficult, it's not a lot of money that you need. So you need to really sit down and figure out what are the things that you really can cut from whatever you make. Remember, I was saying earlier on that Rockefeller said, if you can't save 10%, then the seed of greatness is not in you, or financial independence. And I understand this, that people are struggling. There's a lot of challenges that people have. But also I do understand that the challenge in many instances is that we've not really sat down, count our costs, figure out what can I afford and what can't I truly afford. So where many individuals are really not, they are living not where they should be living now. So that makes it difficult because you already have a car note, you have a house that maybe you shouldn't have yet, the cost of putting the children in school. So there are a lot of costs that prevent you from being able to set money aside. And unless you can set money aside, it's really almost impossible to invest. So you need to sit down, count your cost. What I mean by that is that you need to do a budget. Again, I know it's a word that sounds big to many people, but it's really very, very as simple as trying to look at what are the things that brings money into your family, what are the things that takes money out, what are the things that you should be, cutting, what are the things that you should, so that even if it is $50 to $100 a month, you saw the power of $60 earlier on. I know that time is what makes it work, but there's power in as little as $60. You might need to deny yourself in the short term so that you can get to where you want to get to. That would be my thought on that first question.
Okay, thank you, sir. We will take the next question. It says, in Nigeria, many of us were raised to see investment mainly as owning land or property. How can we begin shifting that mindset to include stocks or mutual funds here?
Yeah, and that's a very good question. And again, I think it was Tayo that was asking the question along that line before. It's what many of us were taught. I was privileged to have an uncle. Actually, it was my uncle-in-law, or not even my direct uncle, that opened my eyes to stocks investment. And many other people in Nigeria, and that is why, when many Nigerian parents grow, they are waiting for children to take care of them because they've not really taken advantage of these things. Now, in Nigeria, yes, that culture allows that to happen, but no children is going to take off of us here. There's no, if you're waiting for that, you might wait forever. And you might be mortgaging your future. So let's not depend on any child, as it were. All right, so that is just one asset class. I was talking about asset allocation earlier on. Investing in land is still a great investment. In fact, I wish I can talk about different investment tonight, but investing, it should be part of your asset allocation strategy. You should have properties. You should have buildings. You should have apartments. You should have condos. You should have investment in real estate. But if you invest only in real estate, then your asset allocation is out of balance. Okay? There are portions of your asset that should be in real estate, some in stocks, some in bonds, some in treasury bills, and across the board, you should begin to shift your investment into those various asset classes. What it does for you is it allows you stay strong regardless of what is happening in a particular asset class, because real estate will have its own downtimes. The reason people don't know that real estate is risky is because the numbers are not published on a daily basis like in the stock market. That's why people don't think it is risky. You put your money into it, before you're thinking about it again is 5 years, 10 years down the line. So the same thing has happened, but you never saw it happening. So by the time you sell it, it's actually appreciated in value. That's why people think real estate is not risky. It's equally risky. Well, maybe not as risky directly as the stock market, but it also has its own risk. And if you didn't allow time, the same thing that happens to someone investing in stocks will happen to someone investing in real estate. But because it's not published on a daily basis, people don't see the fluctuation, so they think it's not risky. So we need to keep in mind that every investment goes up and down, but the net trend is that it's an upward moving track on all the various investment. And then really and truly also, your diversification and allocation strategy should change over time. Because if I'm 20 years old, I'm not 20 years old, obviously, right? If I'm a young person coming out of college, I have more time. I can afford to invest in things that may be a little bit riskier, in quote, but has a better return. Risk and reward go side by side. They're very, very correlated. So I can afford, but as I get towards 50, 60, I need to change the balance or tip that more in the direction of things that are not as risky as someone that's 25 years old or something, and begin to get ready to be able to, the whole purpose of investing is having money in the future. So when that future has come, some of your money should be available to take out, while some should stay working for you. All right. I hope that answered that question.
Thank you so much, sir. I know we are really out of time, but we still need to take some more questions. And I have a question just to balance some of the things you've said. I know some people are on this call and they are wondering, okay, this thing looks kind of complex. Where do I even start from? How do I even start investing? What is the very first step? I know because of time constraints, you were able to just give us like the preamble of what stock as an investment is or a type of investment. And for
Yes.
some people, that seems like eye level. So
Okay, good.
let's assume we don't have you back on this platform and somebody wants to take action from this little time we've had with you. What would you advise such a person to do?
Excellent.
Yeah.
Thank you, Juliet. I'm glad. In fact, it was one of the things I wanted to talk about and I didn't remember. So I'm glad you brought it up. Any one of us on this line, if you do not have a stock brokerage account, then today is Saturday evening. The first thing I will advise you to do when you wake up on Monday, even if you can have, if you can, do it over the weekend, because most of these companies really, they don't, their online portal are still it's a 24-hour thing is what I'm trying to say. It's not, weekend or not, it's still alive. Is you want to open a stock brokerage account with a discount broker. There are different companies. One that comes to mind is a company called Charles Schwab. Schwab is actually the man that liberalized the stock market, made it easy for, essentially retail traders, you and I, to be able to come in. It used to be only those that, have a lot of money that could participate in the stock market in the past, but they've kind of really liberalized it. So Charles Schwab is a very good one. TD Ameritrade is now part of Charles Schwab. Charles Schwab bought it. But there are a number of them, not all of them comes to my mind right now. But at least if you go online right now and just type schwab.com, SCHWAB, you can open an account tonight. So the first step is to open a stock brokerage account. So these discount brokers like Charles Schwab, for example, you can buy a stock without having to pay any commission. So they get paid from the companies essentially that own the stock. So the individuals buying the stock don't have any cost of trading. When I started investing many years ago, it was, I think, about $15 to trade. Every time you trade, it costs you $15. When it came down to $5, people were excited. Now they've made it even, cost-free essentially for the buyer. So it's all you need to do is to, they'll ask you some information, so that you're a US. Someone just posted Schwab. Oh, that's Juliet. Thank you. There are a couple of other ones. Fidelity is not a discount broker, but it's, but anyway, that's my first advice. I open that account and begin to fund it. It will be the next step. Now, there is more to this. You need to kind of learn a little bit more, but don't wait till you know everything. The problem with that is you won't get going. So, but start funding it, even if it is $10, put it there. And that's one thing. That is what they call the law of attraction. Yeah, I don't know if you've all kind of had this experience. If you drive a particular kind of car, it will seem as if you start seeing that car on the road. I don't know if you've had that feeling before. It's called the law of attraction, as it were, psychologists. Once you start going in this direction, it's like you attract opportunities to yourself. You start seeing investment opportunities that you simply didn't see before. Okay, so that's my advice. Open an account, start funding it. And once you start funding, start looking at what can you invest in. I also want to advise people in picking individual stock can be a little bit daunting if you've not done it before. You don't have anyone to help you, but you don't need to invest in individual stocks. You can use index funds. With an index fund, you can participate in stocks, you can participate in bills, you can participate in bonds, you can participate in gold, you can participate in all asset classes through index fund. There are index funds for everything. So what an index fund is really, time did not allow me to explain it. It's really, you like a company pulling money together and then investing it in multiple stocks that are part of an index. Now, the difference between an index fund and a mutual fund is that mutual funds are traded based on what the manager of that fund thinks will make money, because they're trying to achieve what they call alpha, to beat the market. Beta is market performance. So they're trying to achieve alpha to beat the market. On the other hand, index fund doesn't get traded, because there's already, you probably heard the term S&P 500. S&P means Standard and Poor. There are 500 companies in that index. Now, for you to be a company in that index, you've already been qualified. You've met certain criteria. So they're not, they're not trading anything. They're not trying to beat the performance. They're trying to mimic the performance of that index. When you trade stocks, you hold taxes, especially if you trade it in less than 1 year. And taxes eat out what will have compounded for you. And that is one of the key disadvantages. On top of that, when they trade stock often, the manager of the stock will take money for themselves because they are helping you. But because there's no trading in an index fund, there's no money for them to pay. So generally speaking, what they call the expense ratio of an index fund is very low compared with that of a mutual fund. So I've explained 3 things tonight. Open an account tonight. Go to that link that was shared. It's not my company. I'm not selling anything. Another one is Vanguard. Vanguard is more towards corporate setting, but that's another option. Robin Hood, actually, I think it is. It's not Robin Hood. I think it's Robin Hood. It's a discount broker as well. That's another one you can invest through. So open an account, start funding it possibly tonight, latest by Monday morning. That will be my record. And don't wait till you have a lot of money. And then start investing it in index funds. Now, there is allocation and diversification, but that's taking it to another level. Even if you don't properly allocate or diversify right now, start putting it in index fund. If you buy one index fund, an S&P, index, you are essentially invested in 500 companies with $10. So that's my advice on how to get going.
Yes, I don't want to lose my train of thought here. So you only talked about index fund. How about ETFs?
Yeah. So ETFs the meaning is electronic traded funds, right? So they are funds. However, they are traded on the same frequency as stocks. Okay. So there are trading going on in there. There's a lot of movement within ETFs, which will cost you as a result of trading, So, but it's also an option, for your investment.
Thank you so much for that. So I would quickly take the next question. This person said, what are some risks associated with investing in the stock markets?
Mm-hmm.
That's the first question. The next one is, how do stock splits affect the price of a stock?
Good questions. The key risk is if you are short-term focused. That's the key risk. And I think I shared in the chart that I showed earlier on that if you come in at the top of the market and you choose to leave because of the stock is going down, you're actually going to lose money. Stocks are, generally speaking, twice as volatile as most other investment vehicles. So when you have to properly, reduce your risk, you need to have a diversified, portfolio using allocation and diversification, like I explained earlier on. So the key point I'm making there is that the risk of coming in high and going out low is a key risk. But to manage that risk, you don't maintain a short term, you maintain a long term focus. And then you also balance by not having just stocks, you have other asset classes. That's how to manage that risk. Stock splits. Let me just quickly explain what that means. A company can, let me use a number that we can all relate to. Let's say I have a company and I have 100 stocks. That's what, is in my treasury as outstanding. I can decide that maybe if that stock is being sold for $100 each, so 100 times 100 is what? That's, I think, $10,000. So my market capitalization is 10,000. Now it's become too expensive. So only a few people can afford to buy that stock. And I want more people to be able to participate so that one rich man does not just come and buy my own company. I want more people to participate. I can do a split. And let's say I do a 4-for-1 split, 3-for-1 split. So for every, one that I had, I get an extra 3. Well, what's the easiest math to make it easy in my head? Well, let me just do 2-for-1. 2-for-1 is going to be easier in my mathematical head. So if I do a 2-for-1 split, I will reduce because now let's say each 100 people own that company and each person has one stock. And at the end of the day, each of them invested $100. If I split 2-for-1, each one will now have 2 for every one they had. However, the value of their stock is still going to be $100. So even though we reduce the price, the overall market value remains the same. So 50, instead of now having 100 stock, the company will now have 200 stocks. 200 stocks times 50 will now be still $10,000. So it does not change the value of the stock of the company. It just makes it easier for more people to participate. So Mr. B, before that could not afford $100, now can afford $5, $50. So he will now participate in the market. They do it for a number of reasons, but one of it is for market participation, so that more people can own the stock and reduce the risk of one rich man coming to buy them, as it were. And that's how it affects the price. It reduces the price of the stock, as it were, but not the value of the stock. The value of the stock remains the same.
Thank you so much, sir. Obviously, time is against us.
Yeah.
And we really want to go deeper, but in all of it, we're grateful. Thank you. And we would also like to ask, sir, do you think you would be able to come back for another presentation?
Yeah, I'll be glad to. Just
All
need
right.
to schedule it in advance. Absolutely.
Sure. We'll communicate with you on when it's convenient for you, so you can fix us in your calendar. Thank you so much. And everyone, please drop a message in the chat. This has really been a productive evening for most of us. And the questions have really helped us look further than the slides that you came up with because of time. Thank you so much. We appreciate the tips, the practical wisdom that you gave to us all. And we pray that we'll make use of these to multiply our streams of wealth and income. Thank you so much. And we look forward to having you again very soon. God bless you, sir. And I also
Thank
want
you
to
for the
thank
invite.
everyone for joining in today. You guys are the real deal. Staying over time just to get something is a big deal for us. We appreciate you all, and we believe that more sessions to come would also give you the same effects like this. So please, let's endeavor to always show up like this often. This is the only place that we are getting things like this for free. I believe there are people that get to pay for trainings. And I was even going to ask that, do you offer trainings? But let's leave that for later. But if you have to talk on that, no problem. But I believe some of us wants to reach out and say, okay, sir, how can you hold my hands to go this route? What are the recommendations you may have for me to make an informed decision? But nonetheless, we are grateful. Thank you so much.
Yeah.
Thank you. Thank you. And if you have recommendations, please, we can always reach out to Pastor Lanre. He's one of us. He's in the house. If you want to personally contact him, please do. he might have something that he was unable to share here, and maybe some of us couldn't ask questions right here. You may want to ask questions later from your jottings. Please reach out to him. And thank you so much. On this note, I would want to drop the mic and allow all of us to go enjoy our evening. God bless you.
Thank you, Juliet, for facilitating. And thanks everyone for listening. It was a pleasure to be here. Thank you.
Same here. All right,
Yeah.
sir. Bye, everyone, and have a great rest of your weekend.
Thank you.